Hey everybody, I'm Mike Desepoli and welcome to the Heritage Market Pulse for Friday, October 1st, 2021. We hope you had a great week. It's the turn of a new quarter. We have a lot to discuss as we close the curtains on Q3 and get ourselves ready for Q4. A lot of moving parts in the market right now, as always, right? We want to talk about what we see in this market. We know the price action has been a little bit discouraging for investors over the last 2 weeks, so we want to talk about that and how that sets us up here for our move into the fourth quarter. So markets bouncing today to start the new quarter. Obviously, we saw a lot of weakness over the course of 2 weeks, so it's nice to see the markets starting to firm themselves up and turn themselves back out higher. No single catalyst here today. Potentially, some would point to the fact that Merck, the drug company, announced that they may have an oral treatment, preventative, some sort of a therapeutic for COVID that there is going through the approval stages right now. So some market participants pointing to that for the reason for the bounce in the markets. But we just think the markets have reached an area of being very oversold. Now, if we take a look at the last couple weeks, and it appears that the markets have given back a lot of their hard-fought gains, from earlier in the third quarter. And it's important to remember, number one, we've talked about it ad nauseum, the seasonality of September is not very good. But a choppy September sets the stage for what comes later in the year, right? There's a purpose behind this choppiness in the market. And that type of choppiness tends to flush out retail investors, can kind of convince them that trading is not for them. It increases bearishness and negative views of the market, and it allows larger institutions to rotate into underperforming assets, and all of that feeds the greater bull market. So while it seems like a lot of small negative activities converging together to create some problems for the market, we think it's good for markets to take a breath, to take a step back. We don't like price declines any more than the next person, but in the greater context of this bull market run, it's important that we see that as well. We also think there was something very misunderstood last week in the Fed meeting that has led to some of the weakness in the market. Now, Fed Chair Powell was testifying before Congress, being pressed on monetary policy and different related issues. And one of the things he said that caught the markets off guard, which really should come as a surprise to nobody, but after months and months and months of the Fed insisting that these inflationary pressures that we're seeing are just transitory, something that would eventually subside, he said, quite honestly, inflation's hung around a lot longer than we thought it would, and it's becoming a problem that may last into next year. Anybody that's been in the real economy would say, well, that's pretty obvious. I mean, there's no way that it was just transitory the way we've seen some increases. But to hear it from the Fed chair certainly caught markets off guard. That caused Treasury yields to rise, and some of our growth assets started to decline because they tend to move inversely to Treasury yields. That has started to right itself over the last couple of days after people really got a feel for what the Fed chair was going for there. And really, he was more so confirming their desire to be patient with monetary policy. He was not raising a red flag for problems in the monetary markets. But nonetheless, it bears watching, and anytime he speaks, the markets are going to pay close attention. It appears that we have averted a government shutdown. A temporary deal has been signed to continue to keep the government open. The next big date to focus on will be October 18th, which is the debt ceiling. And really, that's another piece of this whole puzzle that's been weighing on the market between talk about Fed policy, the government, Congress, Senate, both parties fighting with each other about future bills, debt ceiling, government shutdown, and then the fact that Biden's larger infrastructure package right now appears to be on the ropes. The market is dealing with a lot. These things will come to pass as they always do, and we feel that this market will resolve itself higher. Quick look at sentiment. I know we're going on a little long today. Sentiment check, fear and greed index, it still sits at 27, fear territory. People are still scared of this market. As contrarians, that is something that we like to see. We expect trends to shift as the new quarter is now underway. And as we get to the second half of October through December 31st, we are in a very seasonal time of year. As a matter of fact, the next 7 months really are the most favorable times of the year when you look at seasonality and investing. So that's all we have here for today. We hope you guys have a great weekend. If you have any questions, reach out to us. Always happy to talk to you about the things that matter. And we'll see you back next week for the Heritage Market Minute.